The 2018 Tax and Jobs Act allowed for bonus depreciation and a whole bunch of passive losses that you could extract from deals that do cost segregation.
The bonus depreciation was, hey, if you have 5, 7, 15-year property, anything less than 20 years, you could choose to accelerate the depreciation. Let's say you have carpeting and you put $100,000 of carpeting into an apartment building. Normally, you'd get to write off $20,000 a year as a deduction because the whole carpet will last 5 years. So you'd take $20,000 each year. What accelerated depreciation allows you to do is just boom, take it in 1 year. You have this huge incentive because about 30% of most buildings are 5, 7, 15-year properties. So all of a sudden you can accelerate your depreciation at any particular time. You could choose 5 years after owning a building, boom, I'm going to take it. And you have this acceleration where you can really accelerate what you're able to do. Sometimes it's 50, sometimes it's 100%. It depends on when you put the building into service, but you can do the acceleration. And all you're doing, there's nothing crazy about it. You're just writing it off early. You're still going to write it off over time, but it's almost like getting a loan from Uncle Sam for no interest. It's saying, hey, I know I'm going to get the tax benefit over the next 20 years. How about you just give it to me now? Getting an early Christmas present.
So if you guys miss it, the rule of thumb is about a third of the building gets written off in the first year. But to simplify it even more, a lot of these deals, you're trying to max out the leverage, 70, 80% loan to value. So what I've seen is passive investors that put in 100 grand, they're getting anywhere from 60 cents to almost $1 back in that first year bonus depreciation, 60 grand or 80 grand back, depending on the deal.
Offsets passive income unless you qualify as a real estate professional. What you might see is the accelerated depreciation, I think in 2023. So in 3 years, 2 years, really, we'll start to go down to 80%, then it'll drop to 60%, and then go down from there. I'm not certain, but I haven't looked at it in so long. If it goes away completely, I'd be shocked. But sometimes it goes down to 50%, which is still pretty good. Not always do we accelerate the depreciation, especially not on the 5-year property. Sometimes you just let it spread because unlike you, you're a real estate professional, you had massive amounts of deduction, but it doesn't help you to get really to zero because the lower tax rates are pretty low. I'm okay paying 12%. I'm okay paying 22%. What I'm not okay is paying 39.6% on rents. I'm not okay paying 37%. I'm not okay paying 32%. It's getting too high plus my state. So sometimes it's just about making sure that you're hitting that number. So I tend to look at 200,000 and say, if I can keep people around $200,000 a year, that tax hit's not going to be so extreme. You get up into the $500,000, 600,000 range, every dollar, so much of it is being taken away from you. For every dollar you make, let's say we had the Biden plan. For every dollar you made after $1 million, if somebody was taking 60% of it, and that's really what it gets up to. If somebody is taking that much away from you, you probably don't have much incentive to make money, and it's hurting because it's not always cash that you're receiving. Sometimes it's profit that's flowing down via K1 or your investment. You don't have the cash. Now you have to liquidate assets to pay the tax bill. And that's what we want to make sure that you're never in that situation.